Hey, this is Sasha. Thank you so much for joining me in this week's episode. Today we are focusing on trading options for the beginner, not the dumb person, for the beginner. If you're brand new, you're just starting out, and we've all been there. Brand new, starting to ride a bike, you're going to fall. Brand new, starting to trade options, you're going to have some losses, or you're not going to know what you're doing. That's what we're going to cover today. So let's get started. I'm going to try to make it quick and easy because people like short videos nowadays. But if you like more detailed stuff, be sure to check out our courses at tradersfly.com and learn.com as well, where you can get up to 20-hour courses of in-depth option learning. But with that being said, let's go to paper, and I'm going to try to just make it simple and quick for you to really understand how option trading works. So here we go. All right, so to go and understand trading options, there's really, you got to think about this kind of like the insurance business. Okay, so insurance is really what options are. Okay, so you're insuring stocks. Sometimes when you insure a car, you're insuring a vehicle. It's a little bit different. Insuring stocks, you're insuring options. So this is you're insuring stocks, or let's look at a car. Okay, so if we look at insuring a car, there is a time issue involved, right? You buy insurance for 1 month, 2 months, 3 months, 4 months. You buy a time. There's a premium involved. Okay, that premium costs you money. Okay, and with time, that premium decays. Okay, so basically, eventually, you have to buy more premium so that way you go ahead and stay insured. So every time, that insurance company makes money. With options, no different. Okay, you have all this same thing. You have a time, you have the premium, and it decays. They decay, and that's really where a lot of people lose money with options, because they buy a lot of options and they go ahead and hold them, and it decays, and you lose money. So when it comes to the insurance business, I'm talking about insurance business. If you look at it as a business, there's really two parts to it, right? You can insure the person, meaning you're the business owner, so here you're selling, or you can be the buyer, right? Most people are the buyers, right? You're buying insurance. But who makes the most money? Think about it. If you're buying insurance, are you making money? No, you're buying it. You're losing money, right? You're protecting yourself in case you get into an accident. But who has the biggest buildings in the workplace? It's the insurance companies. Okay, so they're selling. In options, the same thing. You can be a seller of premium, or you can be a buyer. What's the easier approach? Well, it's easier to be a buyer. Okay, just like here, it's easier to be a buyer. Most people are buyers. Here, most people are buyers. Most people lose money when they buy insurance, and here the same thing. Most people lose when they buy an option contract. In our case, what we want to do is we want to switch. We want to be the seller. We want to be the insurance company. And that's what I'm going to show you here in the simplified version of how you make money in options. So here we go. All right, so how do you make money in options? Well, you are a seller normally. But before we get there, let's do the option basics, okay? Because the basics of options are important to understand, because you got to know and understand how to speak the language, right? If we're talking about phones, you got to understand when I say Android, when I say Apple, when I say the screen, when I say the volume button. You got to know these kinds of words, right? If I tell you to restart your phone, you got to know these kinds of different things. Are you talking about an Android device, an Apple device, all those kinds of things? So let's look at the discussion when we look at the basics of options. How do we talk about this? Well, there's kind of, let me just do a trade grid just like you would see it. First off, you got to know the stock you're talking about. In our example, we're going to do Netflix. Okay, this is a ticker symbol, NFLX. You can also write it out, call it NetFLIX. Okay, now stocks are based on prices. Okay, for the options, you have all these different prices that come up. This is your trade grid. Okay, in here, the stock price might be, let's say 180, 190, 200, 210, 220. Think of this as like, where do you project, or how much insurance are you looking to get, right? In a car, hey, do I want a $250,000 plan? Do I want a $500,000 plan? It's the same thing. Hey, how far do I want to go? And now, as we look at this, okay, we'll just draw this out. here's our trade grid. Okay, well, are we looking at calls and puts? Okay, so here's kind of a little bit different when it comes to trading options. Here, stock prices can go up and down. And what you can do is if you're normally a buyer, you're looking for things to go up on the call side. If you're a buyer of a put, you're looking for things to go down on the put side. Okay, but remember, there's 4 parts to the trade. So just like in the insurance company, well, you could be the buyer and the seller. And here you could be the buyer and the seller of the calls, and you can be a buyer and a seller of the puts. So you can buy these or sell these. You can buy these and you can sell these. Okay, if you're a buyer, you're looking for things to go up. If you're a seller, you're looking for things to go down. If you're a buyer of the puts, you're looking for things to go down. If you're a seller, you're looking for things to go up. Okay, it's kind of opposite, right? So let me highlight these for you. Okay, we're gonna go a buyer here on the call. This is green. A seller here. This is green because it's going up. Okay, it's just a little bit of a difference. A seller here, and this one's a buyer. Okay, you're looking for downside movement. Okay, so now you're looking at these different prices. So now you decide, okay, well, do I want to go ahead and take a single directional bet? Okay, the single directional bet is what most people start out with. Well, if I say, hey, well, if I'm looking for prices to go up, I want to be a buyer, I want to go ahead and do one of these right here at, I'm estimating around $200 is maybe where Netflix will go, maybe $220, depending on where the stock price is. You could buy it further out or even get it already where it's past. And that just allows the movement of your return to be a little quicker. So here, if this is, let's say, $5.70 for that contract, each option contract is worth or controls 100 shares. So you really multiply that times 100. So your cost would be $570. Okay, it's the same thing on the other put side. So if this was $3.30, okay, it's 100 shares that you can control. So it's $330 that you would pay if you're a buyer. Now, if you're a seller, whole different world, right? Now, let's go to kind of a trade grid. I'm going to show you the trade grid on a live platform right here. So if we go ahead on a platform, here's your trade grid. Here is Netflix. So here we have the date, the amount of time we have left, just like you do with car insurance, 30 days, 60 days. Here's one 38 days. Here's 45 days. Okay. If you go ahead and look at, here's our ticker symbol, here's our days, here is our calls, here is our puts. Puts are on this side, okay, calls are on this side, and our strike prices are right here, okay? So those are the price of the stock. So if I go ahead and reduce this to, let's say 10, you can see there's 10 from the middle of the current price. Current price is actually $3.53, and that's kind of right there. That is called at the money. So you could go ahead and buy one of these. In that case, you're looking for stock price to go up. You could go ahead and buy one of these. In that case, stock price is going to sell. You're looking for a stock price to sell off. Now, you could also be a seller, which is the right approach. You want to be the insurance company, not, you know, the buyer of insurance usually. When you're trading options, again, a little more in depth, but as a beginner tutorial here, let's just show you what that looks like. Buy a single, and let's go here. Don't worry about which one I choose because that's a whole art on its own. But here is a trade example. So at expiration, you can see, hey, if you're buying insurance, when this expires, hey, it expired, right? You lose all that money. So you're paying $2,230, right? Because the contract costs $2,230 multiplied times 100, right? So $2,230. But the current line, which is the white line, today, it's right there. With time, it becomes worth less and less. So you could get out of it early anytime you want, as long as there's, you know, a person on the opposite side of the trade. So if this does explode to the upside, and let's say the stock price gets to $383, you could get out of it with a $1,644 profit. But remember, with time, you lose money. So every single day, as I move a theoretical date forward, this white line gets closer to the green line. So you actually start losing money, and the amount you lose is this theta. That is the per day that you lose. So if it doesn't move at all, I'm losing $526. But if it does move, boom, I go ahead and make a little bit of cash. Now, if I went ahead and expected or estimated the stock to go down, I could go ahead and buy a put. Buy a single, do a put. Here it is. And now go ahead and you can see the same concept applies. So there you go. If you're a buyer, you're making money in the direction, puts for downward, calls for upward. But remember what we talked about, that you normally don't want to be a buyer because you're losing this money. Well, if you're the insurance company, we can go ahead and sell this instead. And I could also go ahead and sell this instead. So now let's say, hey, I'm looking for an upward movement in the stock. So which one do I sell? Well, it wouldn't be the call, because that one, upward movement, you got to be a buyer of that. It would be you sell the put. So look, here it is. This is what selling a put looks like. You make money when the stock goes up. You also make money. Remember, white line gets closer to the green line. You make money. You make $16 a day as that continues to go up. Now, if it goes against you, you lose money just like you would in any other investment. So with time, that white line gets closer and closer to the green line, but you're the insurance company. So you're making money as these things expire. And as they continue to expire, you go ahead and sell them the next month and the next month. Now, where do you have a problem? Well, as an insurance business, where do they have a problem? Well, if somebody gets into a big accident and you got to pay off. So if these stocks do crash and pull back, you could have a huge problem. Right? So that's one of the big issues with options right here, is that this can continue to go down. This is also called a naked spread that you're selling. If you're looking for a downward movement, okay, you could go ahead and sell a call instead of buying a put. So in this case, boom, the stock can now go down. And even if it doesn't go down, stock stands still, you make money. Stock goes down, you make money. Even if it moves up a little bit, you still make money because from the premium decay, as long as it's not that strike price. Now, I could go ahead and insure it for less or more. So let's say I go ahead and move this further this way, or I could move it further up that way. Now, in this case, you're safer. The safer you get as a position, meaning now this stock can go all the way up to 398, basically 400, because that's my strike price there. It can go all the way there and I still profit, but the downside, there's a trade-off. The downside is I don't make as much. So the safer the position, the less you make. Less risk, less reward, but you're making money, right? Stock stands still, you make money. Stock goes down, you make money. Stock goes up a bit, you still make money. If you do the same thing with selling the put, you could also do the same thing. Move it way wider here. And you can see now your range has increased quite a bit. So that's really how the right approach is to making money when it comes to trading options. And that's kind of the basic tutorial for a beginner's guide in a very short amount of time. You could go ahead and get more into this, which is because of this is naked, you need to go ahead and protect it because now you don't have any protection. So if this one is selling a 300, well, what you can do is you can buy protection just like insurance companies buy insurance on the things they insure. So in that case, I'll buy a protection here, and now it caps my losses off. Because otherwise, if that stock does tank and continues to go down further and go down further and further, that becomes a problem. So what you do is you go a little bit out and you buy some protection, and now it caps your losses right there. And this is called a vertical spread. You can do many other types of spreads, but that's kind of the basics to looking at trading options, getting started with options, and that's kind of what you're looking for as you're getting into the options game. It simplifies things, and I hope this shows you, hey, there's 4 parts to the trade. You could be a buyer, you could be the seller, and you can be a buyer and seller of the calls or the puts. So a buyer of the call, a seller of the call, a buyer of the put, a seller of the put. 4 different areas you could be in, and working those different contracts can create unique and different types of spreads. So that's a vertical spread. There's also, you could do calendar spreads, diagonal spreads, and that's the typical better approach to trading options, because now all of a sudden you have a positive theta where you make money day in and day out if these stocks don't even move. So thank you so much for joining me. I hope this was helpful, gives you some basic insights to trading options, what you're kind of looking for. I want to just do a short video to explain it for you. And of course, there's many more videos out there where we can get into further detail. And if you definitely want to go into more detail, you want to see hours upon hours of detailed information about trading options, check out one of the courses that we have on our website at tradersfly.com and learn.com. And we definitely pack a lot of knowledge into those courses about trading vertical spreads, the business of options, trading calendars, iron condors, all the good stuff if you really want some detailed knowledge. Thank you so much for joining me. Remember to hit subscribe or join the mailing list. I'll see you next time.